Welcome back to the Williams Real Estate Channel. Today we're discussing all things negative gearing and the capital gains discount. What's the latest in the news? The Labor government's talking about scrapping negative gearing. What could this do to the markets? Firstly, to explain negative gearing, this is an example. Say you bought a property for 700,000, 800,000, and as an example, is bringing in 30 grand a year in rental income. However, you had 50 grand worth of expenses, you would make a 20,000 net loss per year. Current laws are that you can use the negative gearing to offset some of your income tax. As an example, if you had a $200,000 personal income, that $20,000 loss from the negative geared property would allow you to reduce your taxable income. So your personal income after negative gearing would then be reduced to 180,000. So reducing your taxable rate and an approximate income tax savings of around 8,200 as this example. So the Greens are pushing hard to remove it. They believe causes property speculation, it's negative gearing, but anyone who has studied very basic economics will know that in order to get rid of anything, you put taxes on it. So if you want to get rid of more investment properties and more rental accommodation, a great way to do that would be to scrap negative gearing. You'll see less people investing in property, as it is essentially an incentive to get the likes of the mums and dads who aren't super experienced in property investing to the table to buy investment properties, to rent them out, to create more rental accommodation for the public to rent. So I don't advocate negative gearing. If they got rid of it, it doesn't really bother me because all the properties we buy are neutral to positive geared within 6, 12, 18 months, 2 years. The aim of the game is to create your portfolios so they are positive. So you can then borrow more money from the banks and keep growing your asset base and keeping your portfolio neutral to positive gear, just like a business. You want to make sure that it's making you money so then the banks can keep lending you more money so you can keep growing and building your portfolio. So when I see people getting stuck at one or two, 9 times out of 10, they've bought a heavily negative geared property or a large house, as an example, that has a high purchase price, low yield, a low income relative to holding costs. They're in a heavy negative geared position. And when they go back to the bank says, well, you're in too much of a negative cash flow for us to lend you any more money. So they get stuck with finance and locked up with the banks and get stuck at one or two properties. That's how 99% of investors invest, is they go down this negative geared route to save some tax. I don't advise doing it. If you want to build a long-term sustainable portfolio, you want to stick to positive geared properties or neutral to positive geared properties relatively early, so it becomes a cash machine. The banks can then keep lending you more money and keep growing out your wealth as you keep buying more property. Sure, you'll pay tax on that earned income, but stick around. There's a future slide that will bring the light of what the actual real aim of the game is the equity and how to use that equity. So negative gearing, I mean, if they get rid of it, it doesn't really bother me or our business model or our investment strategy. Nothing would change. For us, really, what would I see changing to the marketplace would be less people investing in property, less rental accommodation, because there'd be less investment properties on the market to rent. If there's less supply and ever-growing demand of anything, prices go up. So I would see rents rising if they got rid of it quite rapidly. They're already rising over the last recent years. So continue to compound the higher rents, and then higher rents capitalize into higher property prices, as you never find residential real estate in large metro markets or large regional towns with a yield more than 10%. Once it hits about 8, 9, the price then follows. So if they got rid of negative gearing, they would find less rental accommodation on the market, making higher rents. Those higher rents will then capitalize on higher prices, and it would push the market forward into another growth run. So whether or not they'll pass it, time will tell. Their thinking is a cash grab, not having to refund people's taxes at the end of every financial year. So who knows? The Labor government's looking for anywhere and everywhere to raise taxes at this stage as they continue to spend record numbers outside of recessionary periods, and they're running massive deficits. They're spending over 700 billion a year, and they're not bringing in enough taxes to balance the budget. Hence, they are ever growing the government deficit. So they're looking anywhere and everywhere. Could be on the chopping block to get rid of negative gearing, but if they got rid of negative gearing, I see it only fueling another growth cycle into the property market. So nothing to be concerned about. And negative gearing is not a strategy. It's not an investment strategy. It's a nice to have. If you've got a property early stages, you can offset some tax, but it won't get you anywhere buying negative gear properties, as it is the great way to get yourself stuck with the banks. The capital gains discount. The federal Labor government is talking about scrapping the discount. So what does all this mean? Before we get into it, let's just discuss what is the capital gains discount. As an example, if you bought a property for $1 million and you held it for 5, 10 years, let's say, and you sold that at 2.1 million, you had selling costs of 100,000, you would have a net gain of 1 million. Current rules are if you hold the property longer than 12 months, you get a 50% discount on the capital gain, meaning in this scenario, the net gain after the discount would be 500,000. That capital gain is then added to your personal income. So tax payable with a discount in this scenario, say you're on 200 grand and your personal income at the end of the current financial year would include the 200,000 plus the windfall gain of 500, meaning 700,000 would be your taxable income for that year, meaning you would have to pay 281,000 approximately in tax to the government for that year. They're looking to scrap the discount, meaning they'll tax you on the full capital gain. So what would that look like? In the same scenario, if someone was on 200 grand a year as their personal income with the sale being the windfall gain added to that, so the extra $1 million net gain would mean they would earn $1.2 million for that year. That would then be taxed, a taxable income, equating to approximately 506,000 in tax that you would have to pay for that year. In other words, increasing the tax rate by 80%. So they use cunning words by discount and you're making a saving, but really what it is they're increasing taxes. They're increasing your tax liability. If they were to scrap the capital gains discount, they would be only increasing your tax liability if you were to sell a property. Whether or not pushing this through all asset classes, like in the share market, time will tell. What I see happening is people holding on and not selling. Even personally, brought in this, I would look to reposition and hold for longer until ultimately I see this being short-lived. If this came in, I see this being the start of the end for Labor, just like what happened in 1991-92. History is repeating like clockwork. This guy here, Paul Keating, he brought in similar capital gains tax regulations in the 90s. And it wasn't until after the 91 recession we had to have, Paul Keating's famous quote, the recession we had to have, and Labor got booted out and Liberals came in. John Howard came in for a solid 14 years run, and John Howard brought in the current capital gains discount in the mid 90s, and it hasn't been changed since. Ultimately, if they tweak a few things like this, it's only going to increase taxes on selling an asset. What that will do to the market, I see, is creating a gridlock. It would reduce the amount of transactions. People won't sell because they'll have a massive tax liability if they did sell. So they'll just hang on for longer. There'll be less properties coming onto the market from transactions, meaning there would be less capital gains tax raised by the government, as well as less stamp duty. So they'll actually find that there would be a reduction in tax revenue coming in. If they brought this tax in, it would disincentivize people to invest in property because they'll be thinking, well, if I buy something and have to sell it down the track, I'm going to have to give 50% of the profits to the government if I sold, as well as people will just hang on and refinance. And that is what brings us today is the recycle equity hack. You don't necessarily need to sell a property to realize the gains. You can just refinance. In this scenario, if you had a property valued at $1 million and it had a current loan of 500,000, provided you had the serviceability from the bank, you could increase the loan to 80% of the new value, being $1 million, and increase the loan from 500 to 800,000. The bank would then cash out the difference, being a cash out refinance, and they will debit you the 300 grand cash into your account and increase the loan from 500 to 800. You can then use that 300 to reinvest into more assets to keep growing your wealth. You can also use that equity to supplement your lifestyle. It's your money. Debt is cash. Cash is debt. It's all currency at the end of the day. It's numbers on a screen. So over time, property will continue to compound at 7 to 8% annual growth. In the booms, 20 to 30%. In the slowdowns, 2 to 3%. But on average, you can bank on 7 to 8% per year if you're buying the right types of assets in the right markets with the right metrics. You can bank on consistent capital growth. And that same capital growth will continue to erode the buying power of the currency. So in basic terms, property inflation continues to increase the value of the property and continues to devalue the debt. So $1 million in debt today will be worth $200,000 or $300,000 in value in 10 years' time. Something to get your head around, something to think about. Money is in the refinance because you don't pay tax. You are borrowing off your future self. You're borrowing more debt. You don't pay tax on releasing equity. It's a great way to not only use your portfolio to continue growing and acquiring more assets, but also to use it to supplement your lifestyle. This is by no means financial advice. I can't give financial advice, but this is my story of what I do is I use the rental income from the portfolio to break even positive geared. So it's paying the interest cost, paying the maintenance, upkeep, holding costs, property management, insurance, etc. Pay a bit of tax on the profits, but every 6 months to 12 months, I refinance and draw out hundreds of thousands of dollars, not only to reinvest, but to live off that equity. You live off the equity, tax-free dollars, and then you use the rental income to service the holding costs of your portfolio, and you hold your portfolio through growth cycles where you increase the equity, lower the debt to value ratio, and then you can continue to draw out equity and provide your holding a low debt to value ratio, 30, 40% debt to value. You'll always be in a comfortable cash flow position with a relatively low amount of debt to your value of your portfolio. So something to think about. As always, this is by no means financial advice. This is my story, my thoughts, processes of how I invest, what I'm thinking about, what's happening in the market. And don't be worried about The government getting rid of negative gearing, that'll only push prices up. Same goes for if they get rid of the capital gains discount. I see it being short-lived and will probably be the beginning of the end for the Labor government. As always, this content is general nature and by no means personal or general advice. Prior to making any investment decision, be sure to seek independent legal tax advice. If you want help buying an investment grade property and building a long-term sustainable portfolio, reach out today. Shoot Alex an email. We can send you our roadmap with all the numbers to expect. We can jump on a call, discuss what your plans are, and see if you're a good fit to work with us for the future years ahead. Until next time, thanks for watching.